Hi everyone, thanks so much for joining. It's been quite a momentous week. We've got lots and lots going on. We've got the start of real key earnings data coming from the tech sector. We've got Tesla and Google announcing on Wednesday night. We've got lots of economic data to get through, including the latest S&P PMIs. And they will essentially tell us how the economy is performing in July and as we move into Q3. And of course, we've got all the political shenanigans going on in the UK as well. So I'll go through that. And we've seen some quite interesting developments already this morning. But let's get straight into the charts and let's take a look firstly at the NASDAQ 100. So the NASDAQ 100 is in a bit of a consolidation pattern, as you can see there. It is looking to be trading sideways since reaching that peak. As you can see, we have a lot of the index basically plummeted from its all-time highs. It's been under a lot of pressure, predominantly linked to the sell-off in chip stocks. As you can see here, we have declined from above 30,000 and we're currently trading at 29,165. This is basically a consolidation pattern. It's not too much in terms of what we're doing. It's not too much in terms of a major sell-off for everything that is been going on essentially with the chip stocks, but it has been impacted by it quite badly. Now this chart goes all the way back to this is the daily chart, so it goes all the way back to the pretty much the end of January. And as you can see, on a daily basis, we've just been up and down. There's been no predominant trend, which is a big shift from what we've seen essentially from March to June. Remember, June was one of the record months for the NASDAQ 100. So these are the key tech stocks. But right now we are below the 50-day moving average, which is the blue line here, as you can see with my pointer. And we're currently not quite at resistance yet. This is key resistance, which is the 200-day moving average, which comes in at about 26,500-ish. Actually, it comes in at 26,657. So we are well away from key support levels. So it would take a big shift in gear to get us below that for the NASDAQ 100 to be on a downtrend. But I think, as we can see, we have got some key kind of negative technical drivers at the moment, and that firstly is the 50-day moving average, because we're below there. So that suggests that short-term momentum has totally tipped. So if you follow the pointer all the way through March up until June, it was just upward momentum, upward momentum, upward momentum. We cannot sustain that. We know that markets don't go up in a straight line. And right now we are getting a bit of a flag pattern going on here. And it just suggests really that whilst there are some strong technical sell signals in the short-term basis, what that actually means is that we're still just consolidating. So we're waiting for the next driver. 28,400, that is key support level right now. So that is around about the low from the end of last week. That is worth watching. Momentum indicators, they have dropped already, which is kind of another sign that the uptrend for now is over until we get another driver. But we have got two really key drivers coming up. The first one, of course, being Tesla and Alphabet earnings, which come out on Wednesday. Tesla's had a really fantastic run, actually. Alphabet, obviously all eyes on Alphabet. It's a hyperscaler. It has spent loads and loads on CapEx. It is still expected to produce a monster earnings report to the tune of over $169 billion for last quarter. But it's all about the CapEx. Is it going to increase its CapEx? If it does, the market may not be so tolerant of that. It's shown certainly a limit to what it's doing. But in the very, very near term, so as I'm recording this on Tuesday, what it suggests is that we could just be, there's a bit more positive sentiment going on in the market. The oil price has fallen. We've seen Asian stocks do quite well overnight. We saw a 3.5% rise in the Kospi 200. That's the South Korea index. Why do I mention the Kospi? Let me actually just show you it here on the chart. Sorry, just bear with me one moment. Actually, I won't show you the Kospi, but you'll have to bear with me because the Kospi essentially has risen by 3.5%, but it is made up it's so concentrated with chip stocks, the SK Hynix, Samsung, that sentiment to chip stocks are driving the Kospi. So what it shows essentially and how it performs is a sign of chip stock, how the market is viewing chip stocks. Chip stocks are also really important for the NASDAQ 100, as you can see here, and that is something to watch as well. So Alphabet, their earnings will drive whether or not these big hyperscalers, these big tech firms are actually willing to continue to buy the chips. So they need to continue their spending to buy the chips, to keep the chip stock recovery going, to keep the chip stock rally going. Otherwise, we might see a rotation out of chip stocks into elsewhere. We've seen a bit of that already because we have seen sharp declines in SK Hynix. That was down over 30% at the start of this week, but it's still in bear market territory. We've seen big declines for SanDisk, that's a memory chip maker as well, so something to watch there. Now, oil. I'm just going to bring up our Brent crude oil chart. As you can see here, oil has been on quite the journey. This is also a daily chart, just to show you where it's been. Obviously, we had that big increase because of the war in Iran. We then had the ceasefire. It's then come down. And really, since the start of this month, it's just climbed higher. It's had a run from about $70 per barrel. And we're now trading around about 88, but we had been as high. We did get above 90 on Monday. That was a really key level. It obviously has a lot of macro significance. It's a psychological level. It's got psychological significance, but we haven't been able to hold there, and that's really, really critical. It suggests that the bulls aren't necessarily in control of the oil price right now. Doesn't mean that won't change, because there are many drivers of the oil price right now, and it's not just technical. Now, as you can see, we are currently trading above the 50-day moving average. The 50-day moving average comes in at below 88.50, but we are trading around that level. So it doesn't necessarily mean that essentially we don't know where we are with the oil price at the moment. Obviously, if we trade below the 50-day moving average, that suggests that momentum is to the downside. If we trade above it, momentum is to the upside, still well above the 200-day moving average. So overall, the market remains very jittery when it comes to oil. But looking at where we are, $85 is quite a key support level in the near term. So that is the level that we kind of breached at the end of last week, and that was on the back of kind of renewed tensions, essentially 5 days of strikes. Well, we've had more than that now. They've also started attacks on the Strait of Hormuz. Traffic through the Strait of Hormuz has really slowed to a trickle. However, that's not impacting the oil price right now. And the reason why is because we know that there was a lot of oil during this period as the oil price fell from June through to July. Or from May, through to July, we saw a lot of oil get kind of transported through and get out of the Middle East. So that is kind of a mini supply glut in the market. So supply and demand is still very much driving oil price, but obviously technicals are being swayed by what's going on the geopolitical front. So we've got 92.69. Now that's a key resistance level. It's also a 50% retracement level. Bear with me, I'm just going to draw that on. We go from the top here all the way down. Yeah, so about the 50% retracement level comes in around here where the pointer is. As you can see where my pointer is there. So we're not too far away from it. Now that will be a really critical move for the oil price, for Brent crude. If we do get above that level, then ultimately we'll have had to have some news flow and some negative news flow. Ceasefire's over, there's no peace talks, shutting completely down the Strait of Hormuz. We'd also probably need to see a little bit more targeted attacks at oil and gas infrastructure as well. But obviously still at a worrying time. We're still seeing bond yields rise on the back of this. So it's definitely something to watch. It has repercussions for other parts of the market. Sorry, bear with me there. The RSI actually for, so the relative strength index for the oil price is also at neutral levels. So it's about 48. So it suggests that the market's still in some sort of balance, and that actually the news flow hasn't led to a real bullish move higher in the oil price, but equally that downtrend that we'd so relied upon up until the end of June is probably over for now. UK yields, I just want to talk about UK yields for a bit. They have been all over the place actually. We have seen them rise yesterday as we saw Andy Burnham become Prime Minister. They have since fallen back today, but they had started by moving early, pushing higher. So we're really in a bit of flux. But overall, bond yields in the UK, 10-year bond yield remains just above the 5% level. Just checking that for you now, guys. And we're down 2.4 basis points on that 10-year yield. We had risen 7.7 basis points on Monday on the back of Andy Burnham getting the keys to number 10, probably quickly leaving to go to Manchester, but also making some quite unfunded policy announcements. So things like making social care free at the point of entry, a bit like the NHS, that could cost over 18 billion a year. Well, where are we going to get that money from? There was also talk about freezing the allowances, the tax-free allowance for everybody, unfreezing that and extending it so that we'd all be able to earn a bit more before tax starts kicking in. So that really is something to watch there as well. We also have UK, but essentially UK yields, whilst they are falling back a little bit today, they are still at high levels. So we have still seen about a 20 basis point increase in the 10-year yield in the past month, and that's something to watch. But looking at the UK from a trading perspective, of course, one of the best ways to do that is through the pound. So let's take a quick look at cable. So as you can see with cable, cable has fallen back. So we had a really rush higher at the end of last week. That was driven by a big decline in the dollar. The pound was actually the best performing currency in recent weeks. As you can see, a nice little uptrend there. Still haven't managed to break above resistance at 136. Above 136 in any convincing way. Now that is the high from April. We did make a stab at it, right? So we got to kind of 135.50, but then that level was rejected very, very strongly. Partly that's because we saw a little bit of a comeback in the dollar as the oil price and everything in Iran kind of kicked off. We got those safe haven flows into the US dollar, but it's also because I think there was a bit of an increased political risk premium. So yesterday we saw that if we just look at where my pointer is now, we did see a decline actually in the pound, along with the rise in bond yields. That led to some concern about fiscal pressures in the UK. But as you can see now, we're trading around about the 50-day moving average, and the 50-day moving average comes in at 133.50. Sorry, this is the 200-day moving average, actually, 134.28. So currently trading above the 200-day moving average, but only just above it because we're currently trading 134.30. So getting stuck around that 200-day moving average. Remember, if we can get above here, then that would suggest that the longer term momentum is to the upside for the pound. We're not convinced that that is necessarily the case. But the 200-day moving average, a major level of resistance there. So we need to get convincingly above that before we can make another stab at that 135.50. But as I said, above there, that 136 level is just a bit of a concern. I would say if we look at the broader picture, it's quite constructive. It's cautiously constructive for the pound, but there's so many things weighing on it. We've got the political risk premium from the UK. What are bond yields doing? What's the public sector data saying? Government debt and borrowing and things like that. Remember, if that looks bad, then there's usually a domino effect, and we see weakness in the pound as well. We've also got to think about, well, what's the dollar doing? How are the safe haven flows going around the world? So lots and lots of things. I would say this is a cautiously optimistic setup for the pound. But guys, thank you so much for joining. We really appreciate it. Do watch those earnings releases. We'll be covering them live. Also, do take a look at our YouTube channel, take a look at our socials, and we will be back next week. Thanks so much, guys.